Could you walk us through your selection process for your stocks? And could you give us an example of a stock that you've chosen using this process?
Yeah, so I'd start, I guess, in terms of philosophy, it's really the starting point is looking for a portfolio of companies with, sustainable competitive advantages,
Yeah.
strong financials, and predictable earnings. And that is how we manage really from the starting point is manage the downside risk. In terms of that philosophy, it really helps protect you there. And I also want to highlight that this is a bottom-up process, right? So this is not a macro-driven fund or it's not a quant-style fund. It's very much bottom-up,
Yeah.
stock by stock, analyzing the industry, financials, and management. And I guess just to kind of be a little bit more specific, in terms of analyzing companies specifically, it's really six key criteria we're analyzing, and they are, management. And what we're looking there for a really experienced management team with a proven ability to execute, and also one that's culturally aligned with us as fund managers
Yes.
in terms of being able to go through focusing on the long-term journey of a company and making sure that company is not only resilient, both from its financials, but also resilient in terms of able to grow its value over time and through time with a focus on risk. And it shouldn't surprise you that financial, of course, will play a very important part in terms of one of those six criteria. And again, they're really, really focused on cash flow generation, so the resilience of the cash flow, but also on the balance sheet. And so
Mm.
often, comparing different companies and focusing on what actually sits on the balance sheet in terms of risk, but also opportunity in terms of assets that might be sitting there that might not be, rewarded by the market in the short term, but we can see over 3, 5, and 10 years that those actually assets create enduring characteristics or create resilience in their business models. For example, a company that owns its land and buildings is much more resilient than a very similar company that's got sale and leasebacks and
Mm.
kind of tied itself into long-term leases, as an example. And earnings transparency is very important to us as well. And so if we don't understand the financials, we can't actually model them. We're very happy just to ignore those companies in terms of in the investment
Okay.
set.
Yeah.
We
Yeah.
don't need to invest if we don't understand something.
Yeah.
And then the third criteria really is industry and company position. And then we say, look, ideally, if we could find, and if every one of our companies was effectively the market leader in an industry and it was operating in a growing industry,
Hmm.
and it had strong competitive advantages and pricing power. If we could find enough of those, that would effectively be, our entire portfolio would
Yeah.
be made up of those companies on the ASX. Yeah, effectively ticking all of those boxes is impossible, but that's what we're looking for in effect.
Yeah.
The market leaders, if we can find them. And then valuation is the other one. And valuation is really, of course, it's a driver, but we acknowledge that you can never model accurately where a company will be from a valuation perspective, where it is today. The DCF is never going to be right because you don't actually
Mm.
know where a company is, where it is in its journey. And so we do make sure, and it does govern how much in terms of the size of a position. So it will, but it's important to recognize that even if we think a company is expensive today, it can still sit in the fund because we do acknowledge that a company over 3, 5, 10, 15 years,
Mm.
it, if they're growing, if they have a great management team, if they have strong cash flows, those are the companies that have an ability to surprise us either through strong organic growth better than we expect, creating new product, new IP, or
Mm.
through acquisitions that surprise us in terms of their ability to create value through acquisitions, which we don't normally like, but some of the better companies
Okay. Yeah.
are able to execute acquisitions really well. And then finally, I just touch on sustainability is important. So we
Hmm.
are looking at governance. We are really focused on the composition of a board and making sure
Yeah.
that the KPI alignment's good, but also environmental policies, social policies, and really the way governance is managed by a company can either make or break a company. We are very mindful of that in our process. So that is one of our six key criteria. And then market factors, finally, something like effectively key themes in the market. So for example, we might own a data center at the moment and we might think it's a bit expensive, but it might still warrant a position in the fund because artificial intelligence is a theme of
Yes.
probably the next decade,
Yeah.
and it's important to have exposure, to some of those fundamental thematics. And again, we would never invest in a company based on simply thematics, but if we have a position, you might find, even though we would normally trim because it's gone up 10% or 15% in a month, it can play a part in portfolio construction in that just having some exposure or timing our exit on some of the names on the back of, effectively market factors like thematic or even index inclusion, where
Mm.
there's going to be 50 days worth of buying over a week or two, where you time your exit over a 2-week period going where there's huge liquidity. So there are things like that where you are mindful, I guess, of the market and market factors in your investment process, but it's very much at the margin. And I think you said, is there an example? Yeah, so domain, I thought, yeah, in terms of like domain.com, most of us probably have the app on our phone. It's
Definitely.
probably a good example in the small cap space. And it's probably a good example because in our mid cap fund, we own realestate.com. And for small cap clients, actually, that they own domain.com because we think the asset class, so the industry in Australia in particular, both of those businesses being effectively a duopoly, realestate.com being the market leader. And as I talked about before, if you find a great management team running a great market leader, strong pricing power, strong margin, a strong cash flow, and that company is investing, then you want to invest in that company. And realestate.com ticks all of those boxes. But Domain being the number 2 player, what we have found analysing, and for as long as I've been in the industry, Domain has been working away at trying to build its business and its moat. And it is a strong number 2 player in Australia. And there is no real number 3. And so you have it, in effect, a duopoly market. It's not as compelling as realestate.com because it's smaller revenue, but they still do have very strong pricing power. In fact, they just put prices up for next year by 8%. And they are developing new products which have a higher pricing tier in the market. And so they would like to see through the cycle revenue growth of about 12% per annum over the next 3 to 5 to 10 years if they can attempt it strategically. And that's actually probably not as strong as realestate.com. But in its own right, if you have a business that is already delivering 34% margin, and growing revenue at a compound rate, hopefully of 12% over, let's say, the next 3 years. In 3 years' time, that business will be, in terms of revenue, it'll have 40% more revenue than it does today. And the opportunity to either invest some of that to grow the business or to maintain the moat of the business will mean we feel confident that the business should be able to protect its number 2 position in the Australian market, grow revenue and grow profit. And we have that confidence, not just because they are actually delivering exactly that, but because we are confident that the management team is, the CEO's ex-Google, but also they've got a management team that's been there for a very long time, like the broader exec team. They also have Channel 9, so 9 as its number 1 shareholder, so 61% shareholder is 9.
Okay, yeah.
And that's their most important asset. But they have that effectively the media relationship they have with Nine means they can extend the reach and brand presence of Domain in the market. So every time you go on to, one of Nine's assets, whether it's television or their print assets being Australian Financial Review or Sydney Morning Herald, and looking at the property section, for example, you're getting that exposure to Domain's assets. And that means, it becomes very hard for a competitor to come in and effectively break that duopoly structure because you've got News Corp there with 60% ownership of realestate.com, and all of News Corp's assets help make realestate.com a stronger business. And you've also got Nine making Domain a much stronger, more resilient business. And so you've got strong duopoly, you've got a strong management team, the financials, the balance sheet's quite robust and resilient. And from a valuation perspective, look, it's on about 30 times 1 year forward PE. Some would argue that's expensive. Some would argue that's really cheap if you compare it to SEEK or REA. So realestate.com. Or to car sales. So it's meaningfully cheaper than all of those. But it's not the market leader. It's not the monopoly. It's not the strongest player. It's the number 2 player. So it does warrant a discount. But again, as I was saying, it's not just focusing on today's multiple. We really are focusing on where this business will be in 3, 5, and 10 years' time when we make an investment. And then on the other factors, really like sustainability, they've got a strong board, they have a strong management team and a strong focus on the environmental and social policy, and just making sure that governance and KPI alignments are actually quite good and robust. So we have no issues there. And I guess not a huge amount to say on the market factors for this one, which again is often not something we put a huge amount of weight on in terms of our focus.
Well, thanks for sitting down with me. Really appreciate the in-depth process of your fund.
It was my pleasure. Thank you.
Pleasure.